All right, so once again, good afternoon. So the first question will be dealing with is CSZ code. Also, we'll look at CJ code, then TUFA code, DATI code, and copper code. So the intention is to finish all of these questions today being the final revision class. And it's important if you have to go or do extra time on it, please let's prepare ourselves to do that. Okay. And that's why I've also sent out the solution to the discussive part so that we can all go through it before the class and then we can flow together and save time during this revision. So let's quickly look at the content we are supposed to cover today. So our focus will be on the following: working capital cycle, how to calculate it, how to interpret it, and all of those things. Relevant accounting ratios, how to calculate, how to interpret it, and also working capital financing policy. I'm sure this is about the scenario base, so we need to find out what exactly is the financing policy the company is using, and if there's any change, what has it changed to? Hedging techniques for currency risk is also part of the question here. Advising on the acceptability of a project. That's in the area of investment appraiser is also part of the question here. Analyzing views on an investment project. So maybe there are different views on an investment project. So we need to analyze it, critique them, and give our opinion about those views. And then calculating a project specific, which is a geared cost of equity, and discussing the steps taken. So this is also something we'll be dealing with here. Calculating WACC, weighted average cost of capital, and discussing the extent of its use. So it's also one of the things that is very germane for us. Of what benefit is a convertible loan note? That's also a requirement today. Calculating TRP, theoretical extra price, and then evaluating a finance option. It's also part of the requirement for us today. Valuing a share using dividend growth model and PE ratio. Also, the agency problem, how will this happen? How do we solve it? Those are the things we also have to look at today. Then probability analysis, how do we apply it to an investment appraiser? So that's also something we'll be dealing with today. So CSZ core, it's on working capital management. So there are 4 requirements here. Please confirm you can hear me clearly, please.
Yes, I can.
Okay, good. So I expect I want to believe that the person that responded is representing everyone. Okay, so moving on. Requirement A says calculate the working capital cycle or cash collection cycle, that's another name for it, of CSZ Co at the end of March 2014, and then discuss whether a working capital cycle should be positive or negative. That's 6 marks for us. Calculate the target quick ratio, or it's called acid test ratio, and the target ratio of sales to net working capital of CSZ Co at the end of March 2015. That's 5 marks. Analyze and compare the current asset and current liability positions for March 2014 and March 2015. So, and then discuss how the working capital financing policy of CSZ Co would have changed. So 8 marks. Then the D part, briefly discuss 3 internal methods which could be used by CSZ Co to manage foreign currency transactions risk arising from its continuing business activities. So quickly, let's begin to address them. This on this page, we'll be addressing question ABC. So we are given the following information. The current asset and current liability of CSZ Co at the end of March 2014 as follows. So as we have them, we can begin to gather our data. So we have inventory, Have trade receivable. $5,007 inventory. 6,575 trade receivable, given a total of 5,275. So let's call that current asset. And we have trade payables. 137. And then overdraft, 4682, given a total of 6819 current liabilities. So we also have net asset, net current asset, sorry. Difference between the current assets and current liabilities as given to us. So this information is for the year 2014. Now for the year to end of March 2014, so CSECO had domestic and foreign sales of $40 million. Sales, 40 million. Don't forget, we are putting our figures in $1,000. All on credit, so which means all of these will be credit sales. Why cost of sales was 26 million. Trade payables related to both domestic and foreign suppliers. Okay, that's noted. Now for the year end, for the year to end of March 2015, CSECO has forecast that credit sales will remain at 40 million. Okay, so here we are in 2015. Is this will remain? And cost of sales will fall to 60% of sales. So what does that mean to you? Can someone tell us? Hello?
Hello. Can get, okay.
So what is that? What are we going to do?
Yeah, 60% of sales.
So we just do 60% of 40 million. This is what you are saying. Okay. The company expects current asset to consist of inventory and trade receivables. Okay. Hello. Can someone mute there? Is the person talking to me? Okay, and current liabilities to consist of trade payables and companies overdraft. So we'll maintain this same classification for 2015. That's what they are saying. Okay. So CSECO also plans to achieve the following target working capital ratio values for the year to the end of March 2015. So this is what they plan. Inventory days for the year 2015 should be 60. Trade receivable days expected to be 75. Trade payable days expected to be 55. And the current ratio expected to be 1.4. Okay, so those are the things given to us. So the question now says calculate the working capital cycle of CSECO at the end of March 2014. So let's look at March 2014. We have our data given to us here. So to calculate working capital cycle, what do we need to do for 2014?
We need to
The
calculate
inventory days.
in the
all the
inventory
days.
days,
Okay. Receivable days, payable days.
payable
Okay.
days.
So to do that, for inventory days, what do we do? So we take the inventory balance, 5,700. So the question is, how many days are we looking at? Are we given number of days here?
No.
So we need to make an assumption now. So what do we assume?
365.
365, okay? So each year 365. That's noted. So with that, let's calculate the inventory days. So we have inventory balance for 2014 and then divided by what? Quickly.
Cost of sales. Cost of sales.
Cost of sales, okay? And then multiply by what?
365. The days.
Thank you. So we have this. For receivable days, we take receivable balance, divide by what?
Credit sales.
Credit sales, and then multiply by 365.
Days.
365.
For payable days, we take the payable balance, divided by what?
Cost of sales.
What takes priority, please? My question.
Credit purchases.
But we are not given this.
Yes.
So we'll use cost of sales in lieu. Thank you. Cost of sales, and then multiply by 365. I had that question in case in this diet you are given. So you would say, we didn't tell you. Okay, so working capital cycle for this year will be equal to inventory days plus receivable days minus payable days.
Days.
So we have 110, isn't it? So we've solved that part, one part of that A part. So we have to discuss whether a working capital cycle should be positive or negative. So what would be our response? We've done the calculation, we have 110 days. We know it's positive. So the examiner is asking, should it be positive or negative?
So in my own opinion, I don't think there's a particular route whether it should be positive or negative. It all depends on the inventory, the trade receivable and trade payable days. So if you are paying, if you're delaying the payment for your payables, your working capital cycle will most likely be negative. That's if your receivables are paying you faster than you are paying your payables.
So depending on the nature of the business, that's what you are saying.
Mm-hmm.
As to what? As
to how payments are made and
how long payments are being made and collections being received. So that's what you are trying to tell us, is that not? So it does not necessarily have to be so there's no cast in stone rule to say it should be positive or negative. So it depends on the nature of the business. Okay. So what else can you say here? So give example. Don't stop at this point. So you need to give example. To give example. So think about it, nature of the business. So categorize into two buckets. So let's take manufacturing. What do you think will happen?
So I think in the manufacturing, it will have. So I can't.
So I think it should be a positive in manufacturing.
It should be positive.
Okay.
Yeah.
A lot of this will be tied down, isn't it?
Yeah.
So whereas suppliers would have to be set, isn't it?
Yeah.
So this will make it to actually be positive. Okay. So what do you think will happen to a supermarket?
Should be negative.
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 Reason?
So considering your sales,
Little or no debt, no credit
Yeah.
sales.
So that will not be tolerated, isn't it?
Yes, sir.
yeah.
Level of inventories. Okay. So you will then see that what you see happening, a lot of what happens there will be what? You agree with me?
Yes.
Okay, so you just see payable, increasing. So at the end of the day, you see that eventually it turns out to be negative cycle. So that's what happened to a supermarket. Okay, so with this, you can end that 6 months.
Hello,
Yes,
sir.
please.
Sorry, sir. But is it ideal? Is it good for a supermarket to stay long before it pays its suppliers?
And what we are saying is that it's not as if we are saying is good, but that's what you see a supermarket doing most times. So they'll get goods on credit. They take time to hold the supplier, but they don't allow customers to hold them. So on the side of customer, receivable days will be 0. You understand? They
Yes,
also
sir.
don't
Yes, sir.
want their inventories or goods to stay, long in the shop. So they try to manage that. So if you look at both inventories and receivable days, they will be shorter. but you will see that they hold their suppliers a lot more. Do you understand?
Okay, sir.
So that's why it turns out to be negative in most cases. Okay. You can earn 6 marks here because calculating here, you haven't done so much here. So maybe calculation could fetch you about 2 marks, but I'm sure this discussion will have to fetch you about 4 marks. Any question?
No, sir. No, sir.
Sir. Okay, so please, I have a question.
Okay.
So okay, so some supermarkets have a layaway policy. So like where a customer.
Go ahead, I'm listening.
So where a customer pays little by little for a product. So the money that the customer pays little by little, is it under what is it being classified? Is it is it a prepayment or what?
Okay, so it's not prepayment because my understanding is that you are saying customers hold a supermarket and is paying in bits, isn't it?
No. So a person wants a pair of shoes and doesn't take the shoes yet, but is paying little by little for those shoes.
Okay, so take for instance you, isn't it?
As in what? Sorry.
Take for instance you have bought shoes, Abby, but you are paying instrumentally. Is that not what you're
Yes.
saying?
And
Okay, but you haven't collected the
it is
shoes.
until I finish the payment that I can take the shoes.
Oh, okay. And in your book, you want to record your payments. Is that not so?
Yes, and for the
And that's
supermarket,
financial reporting. For the purpose of financial reporting, that would be a prepayment.
Okay.
Yeah. Okay.
Yes.
So, but you know that is not
What
a
is it?
focus
What did
in
you say
working
remove from your
capital
mouth?
management. Did you hear that? Hello.
Sir?
For the purpose of working capital management, that is not considered as part of current assets. Did you hear that?
Yes.
Okay.
Why? Sorry.
So that's what the syllabus has recommended. So the focus is strictly on inventories and receivable. So because those ones you have gotten items like what you have illustrated, you haven't gotten the item, isn't it?
Yes.
So it is not a focus for us under working capital management. Did you get that?
Yes, sir.
Okay. Any other question? Okay, so if there's no question, we are done with A part. Let's look at the B part. The B part says calculate the target quick ratio, which you can also call asset test ratio. And then also calculate the target ratio of sales to net working capital of the company at the end of March 2015. Quick ratio. How do we determine quick ratio?
Current assets minus inventory over current liabilities.
Okay. So we take out the inventory from the current assets and then divide by current liabilities. In 2015, do we have current assets? Do we have current liabilities?
No.
So we need to work them out. How can we calculate them? So we know, we are told here that the current assets of the company should consist of inventory and receivable. Current liability should consist of trade payables and overdraft. If that is the case, so let's work out those items. For inventory 2015, we have inventory days given to us, 60 days. So we can use that to calculate inventory balance. So that will be equal to what? Inventory days, 60, divide by 365, and then multiply by cost of sales.
Cost of sales.
Is that not so? In this case, we are
Yes,
using
sir.
24,000.
Yes.
Remember, okay? So we have this. For trade receivables, it will be trade
Trade
receivable
receivable
days
days
divided by 365 days that we have assumed,
times
multiply by
credit
what?
sales.
Credit sales.
Credit sales.
Which means we can have current assets as this for 2015 by summing the two. So for current liabilities, we have trade payables, and we have trade payable days as 55. So we'll do 55 divided by 365 and multiply by, since there's no credit purchases, multiply by what? Cost of sales.
24,000.
Okay, so we have this. So what about overdrafts?
We get
How
it
do
from
we
the current
calculate
ratio.
overdraft? We don't have it, isn't it? But we are
Yes,
given current ratio. Current ratio is current assets over current liabilities. So do we have current assets? Yes, but we don't have current liabilities. So we can make an equation and then make current liabilities the subject of the formula. Do you agree with me?
Yes, sir.
So if you do that, it turns out to be current liability equals what?
Current liability will not be current assets divided by
Current
1.4.
By 1.4.
Okay, so we have the current asset as this, and then we'll then divide it by current ratio of 1.4. So this means this is our current liabilities for 2015. So if we have that, that means we can move forward by calculating our quick ratio. Target quick ratio. I just say quick ratio. And this is also measured in times. For this year is going to be what? We are saying we would only consider every other thing in
Trade
current assets
receivables.
excluding inventory. Is that not so?
Yes,
So,
sir.
and the only thing available here is receivable. Why I've said that is because in case there's cash, you must consider it. So every other thing in current assets excluding inventory. Please take note. So trade receivable is the only thing available here once you take out inventory. So we can pick that and then divide it by current liabilities for that year, which we have calculated here. Can we see it? So
Yes,
this
sir.
gives us 0.946. That's what we're asked to calculate. So we're also asked to calculate sales to net working capital. Sales to net working capital. So what is our net working capital for 2015? Net current assets is our net working capital. So how do we calculate that? Which is equal to
Current assets minus current
assets
liabilities.
Minus current
minus
liabilities.
current liabilities. So we have net current assets. So, and we also have our sales. So we can calculate sales to net working capital. And that's equal to what? Credit says we have to
40,000.
divide by net current asset. We have 11.51. And this is also measured. So we have done all we are asked to do in the B part. We are not asked to comment, we are just asked to calculate, and we have done those calculations. So the next thing is C part. Any question on this?
That's from
Let
my
me know.
answer.
Okay. So C part says we should analyze and compare.
Sorry, sir, please, can I see how the sales to net working capital was gotten?
Sorry, I didn't get that.
Can I see how the net sales to net working capital was gotten?
Sales to net working capital. So credit says divide by the net current asset. Have you seen that? Can we proceed?
Yes, please.
All right, so now the C part says we should analyze and compare the current asset and current liability positions for March 2014 and March 2015. We should analyze and compare the two for the two periods, and then discuss how the working capital financing policy of CSZ Co would have changed. What comes to your mind? So current assets for the 2 years, can you see them? Current liabilities for the 2 years, can you see them?
Mm-hmm.
So we have to analyze and compare the positions. So what comes to your mind?
We should discuss the increase or decrease in current assets and current liabilities, net current assets.
Okay.
And the maybe like the reason why. I don't know.
So I'm listening.
So we can start by saying that there was a decrease in the current assets, which is seen as a maybe due to a decrease in inventory, and there was also a decrease in net current assets, which is due to an increase in the current liabilities. So I think that is that's talking
So can
to
we
the
use the
fact
opportunity
that
to determine the overdraft for this year,
yes,
which will be current liabilities minus trade payable? Okay. So,
yeah, so they
that
have
by
an
the time you
increase
are
in their
analyzing, you have things to speak to. Remember, you have to
So-
analyze based on the items. So speak to inventory, speak to receivables, speak to payables, speak to overdrafts.
Okay, so we can see that the inventory reduced. We can maybe sort of like maybe calculate the percentage decrease. I can see that the inventory decreased here from 2014 to 2015, which can be seen maybe as a result of them not holding inventory anymore, or
So
them
I'll
reducing
call
how much
this-
inventory they are
I
holding.
call this percentage change.
Yes, sir.
Okay.
Then we also have an increase in receivables. Most likely they are selling more goods or
Wait, let's
credit.
take
They
them
have
one
been
after the other. So this
Oh,
is
okay.
equal to, want to see
new
what
minus
happens here.
old.
So
over
new
old.
minus old, isn't it?
Yes, sir. Divided
Divide
by
by
old.
old. Okay. So we have this. So this is 31% decrease. Okay. So if I bring the formula to the next one, this turns to 25% increase. To do same for payables, 69% increase. Overdraft, 8% increase. So we can also do same here for the total. New minus old divided by old. So we can see that takes to a 1% drop in current assets, and then current liability increased by 27%. Right? So, and then it extends further, isn't it, to net current assets? Yeah. 6% drop. Okay. So let us also run those analyses on these other ones. Credit says nothing happened, we are told. For credit, for cost of sales, you can see a drop here, isn't it? Okay.
Yes, sir.
All right.
Okay.
So let's now hear from you. So this shows the analysis, and then let's speak to the analysis we have done.
Okay, so like I was saying, inventory, we can see that inventory reduced by 31%, and this is most likely due to the company not holding inventory much more, or like holding more inventory. Comparing that with the increase in trade receivables, we can see that most likely they are selling more goods on credit, which is why they do not have as much inventory in their at their closing date as they had in 2014. So that means that they are selling more items, but they're not collecting the money. That's why they have a drop in their inventory and an increase in their receivables.
Okay, so we can say traceable to increase sales. Is that what you're saying?
Well, we can't say increased sales, increased receivables. I don't know. Can we say increased sales?
No, I'm
if
talking
sales did
about
not
inventory.
increase?
I'm talking about inventory.
Okay.
Just
Yes.
sales did not increase.
But sales did not
Sales remained the
increase.
same, so we can't say
Okay,
increase.
so and sales did not increase. Okay, so that's
Yeah.
also a valid point. So on that note, that point cannot fly. So what do you think could be another reason why there's a drop in inventory?
Probably they changed their inventory policy. They changed the policy they were initially.
So change in inventory policy. Reducing costs to manage what? Cost, isn't it?
Yes, to manage cost, yes.
Okay. That's a valid point. Moving on. So what
Can
now
we link
happens here?
it to the reduction in cost of sales?
Credits. Sorry, I'm coming. More credit sales to customers. So, but remember that sales did not also increase here. So what do you think here? More.
Yeah.
So more time allowed to customers. So someone was saying something about, say that again.
No, I think we've already done that. So looking at the numbers, cost of sales reduced from 2014 to 2015. So we've already done that.
Okay. So what happened to payables?
There was an increase in payables.
So increase in payable, what could have caused that?
Them not paying their payables on time, and as a result, time.
Granted by the supplier. Okay. So then overdrafts. What happened to it?
An increase in overdraft. Yes.
Okay.
This
So
is due
that's
to the extended time.
Sorry?
This is due to the extended time given to the creditors.
Which one is that?
I mean.
No.
Which one is that?
For the
So
overdraft,
he's saying that the overdraft increased as a result of extended time given to creditors. So they need cash to finance the business. So that's why the overdraft increased.
has increased.
Oh, do you think so?
No, I don't think so,
Yeah.
personally. I feel there's an
If their
increase in
receivables
overdraft because that was what they
increase,
used to
meaning
fund
they are
their current
using.
liabilities.
So if you tell me need for cash,
Mhm.
need for cash, because the cash they need, they are not going to use it to settle suppliers.
No.
So it has nothing to do with suppliers in this case.
No, we are saying receivables, not payables. So
Receivables.
receivables
Oh,
payable.
receivables.
increased.
Yes, I agree with you. Need for cash. Okay. So as a result of more cash tied down, isn't it?
Exactly.
Customers. Good. I agree. Okay. So moving on, what now happened eventually? What do you think has happened here? Net current assets. What happened to it? It declined. And what's the implication of this? I told you this, that whenever net current asset decreased, what do you think had happened in terms of funding? Less of long-term capital. You agree with me?
Yes. Yes, sir. Meaning that more funding is coming from short term, e.g. overdraft, just like the same.
In 2015. So less of long-term capital will be required in 2015. So meaning more of short-term, correct?
Yes, sir. E.g. overdraft, which is also reflective.
Yeah. Evidence by, I like that, evidenced. Increase in overdraft and payables. Can you see the analysis? It makes sense. So these are the things you have spoken to now. Okay, so having said this, what then would you say about how the working capital financing policy would have changed? So what do you think would have happened? Just like what we have said here is part of the response to that. We said less of long-term capital will be required. So that is how the financing would have changed. More short-term is anticipated. And we can see that in the increase in overdraft and payables. Okay. Now, in that case, what kind of policy have they been using in 2014? What kind of policy do you think they will be using in 2015? Any response?
Are you referring to those
Like
three
in
financing
2014,
policies
they were
addressing?
aggressive.
Yeah, okay.
See, are you sure? I'm going to confirm what you have said. There are things to use to confirm whether they were aggressive. So look at it. Can you please do current ratio for 2014? Let's see. So this will be equal to current assets divided by current liabilities. 1.8. Have you seen that? Hello? Quick ratio 0.964. Can you see that? Can someone hear me? I can't hear anybody.
We can hear you.
Yes,
Okay,
we can.
good. So can you see that? Quick ratio 2014. Sales to net working capital. Let's do that too. Equals to sales divided by net working capital. Can you see it? Can you see it? So look at all these things we have calculated. Use them to make point on the policy. What will be your response?
In 2014, the company was more conservative, but in 2015, they are more aggressive.
So we can see the trend between 2014 and 2015. It shows that current ratio will decline, quick ratio will decline, which means liquidity will drop. Okay? And then we also can see sales to net working capital ratio. Okay, it's also decreasing from 7.3 times to 11.5 times. And what that ratio is saying is that the higher the ratio, what does that mean? The more aggressive that organization is in terms of managing costs. They are looking for short-term financing. That's what is happening here. Because look at it. Look at what happened here. Look at the net working capital. It dropped. And I told you here that that means long-term capital has dropped. More of short-term is happening. And that's what makes these sales to net working capital to jump up. So which means the change in the policy is from conservative to what? Aggressive. Hello, did you hear me?
Can you? Yes, we can hear you. Can you pick one of these variables to support your explanation? So, let's say current ratio. So current ratio reduced.
Current ratio reduced, and current ratio is about liquidity position. Okay, so the higher that ratio, the more liquid the organization, and then profitability will suffer at that point. Okay, but in this case, the ratio dropped. And when the ratio drops, it means liquidity is suffering. Then the focus in that case is more of profitability. The reason is because you will see that why this ratio has dropped is because they are looking at more of current liabilities. Can you see it?
Okay.
Yes, and you can see it here that why current asset dropped by 1%, which ordinarily should increase if that ratio should improve. If that ratio is to improve, this current asset should ordinarily increase. But look at it, it dropped. And then current liability increased by 27%. That has dropped, that has been the reason why this current ratio has dropped. Because there's more of current liabilities happening in that company now.
Oh, okay.
Okay, so and when you have more of current liabilities, means your focus is on profitability.
Okay.
That. Hello.
Yeah, I get now. Thank you.
Okay. So by extension, the implication will also be on the quick ratio, because while current liability stands in full, current liability has to be managed by taking out inventory. So we only consider the balance, and which means that means that implications still fall on the quick ratio as well. Okay, and also if you check sales to net working capital, you can see it that we are looking at sales to net working capital. What determines net working capital is the difference between current assets and current liabilities. And we can see that because more of current liabilities happen, it dropped the net current assets. As it drops net current asset, it means this balance we call net current asset is being financed by long-term capital. So, which means we need less of finance from long-term capital in 2015 compared to 2014. In that case, when you need less of long-term capital, it means you are not focusing on liquidity, because long-term capital focuses more on liquidity. So that is why this is dropping, and that means this company is changing from conservative to aggressive. So a drop in current ratio from 1.8 to 1.4. A drop in, okay, a rise. Let's look at a rise and a rise. The sales to net working capital. From 7.3 times, 11.5 times. Of course, in 2015 is our profitability. The expense of liquidity. Okay, so this is what we are going to put up as the response to this question. Any question? Hello?
We are here, sir.
Any question?
No, sir.
Okay. So if there's no question, let's move on to the D part. So I have sent this to everyone. So this is saying briefly discuss 3 internal methods which could be used by CSZCO to manage foreign currency transaction risk arising from its continuing business activities. So you agree with me that in the question we are told that the company is doing both domestic and foreign transactions. So how can they manage the foreign currency transaction risk? So where the foreign customers are owing them, okay? Or perhaps they are owing foreign suppliers as well. So transaction risk occurs when a foreign currency transactions, and these are usually in short term, okay? Such as payments expected by a company from trade receivables. So like I've said, there are foreign customers owing CSZCO, or payment to be made, in settling foreign trade payables. So they also need to pay their suppliers in the other countries. and also perhaps interest payments due on foreign currency debt. Okay, that also what can constitute transaction risk. And this is where all of these are being delayed. So payment is not being made immediately, but is deferred into future time. So as a result of that, there's likely to be faced for CSE code to be faced with a transactional risk in that case, which means at the time payment is to be made in the future time, the exchange rate will have changed. So it could go up, it could go down, you wouldn't know what it would be. So in that case, there's an exposure, and that's what constitutes transaction risk. So how can CSE code now manage such a risk? So CSE code can do the following. First, it can do currency of the invoice in the domestic domestic currency. It can issue invoice in domestic currency to say is issuing to the customers an invoice that says he should pay in his own currency, which means CSE code, for instance, is a dollar denominated or a dollar trading company, and then the customer is using euro, for instance. So CSE code can issue invoice in dollar, and once CSE code issues invoice in dollar, it means CSE code is not exposed to exchange rate fluctuations. So it is the customer they would have to look for dollar to settle CSE code. That's what it means. That means issuing invoice in domestic currency. But the question is, will customer accept this arrangement? So most likely customer will reject it to say, no, I have to pay in my own currency. Why will customer want to do this? Because I'm sure you will have options. So there are many other companies that wants to sell the same goods to the customer. So, and they probably would issue the invoice in the customer's currency. So in that case, it is likely that this will not be commercially viable. So in a situation like that, what other options will CSE code adopt? So it could do matching. So when this happens, CSE code would have to open a foreign currency denominated account wherein receipts in foreign currency, payment in foreign currency can always, be made into such an account. So if it's expecting some inflows in, let's say, in euro, and the company uses dollar, for instance, but is expecting some inflows in euros, which is a foreign currency to the company, and perhaps he also needs to make payment to some suppliers also in euros. So he could just open euro-denominated account, wherein all receipts will be made into the account by customers, foreign customers, and then all payments to the suppliers would also be made through that account. So this is what we mean by matching. Receipt and payments in the same foreign currency can be matched. Another option that the company could adopt is leading and lagging. So in this case, the company, the CSE code is anticipating that exchange rates may not be favorable in future, for instance. So what will the company do? It will perhaps, prefer to quickly make the payment in advance. That is what we call leading, because there's an anticipation that exchange rates may not be favorable in future. But if CSE code is anticipating that exchange rate may be favorable in future, so what could it do? So the company could decide to delay payment, so pay in arrears. So that is what we call lagging. So delay it till that time so that payment will be made when the exchange rates will be favorable. That is what we call lagging. So these are options the company can take, and that's why the examiner says internal methods. In this case, you cannot use futures as a response here. You cannot use options here. You cannot use swap here because those are derivatives. So let me ask you, what other options can the company adopt here? What other method?
So I think you have touched on most of them.
How about FRA, sir? Have you touched FRA?
So FRA, forward rate agreement, is used to hedge against interest rate risk, not currency. Did you get that?
Okay, sir.
Yes. All right. So moving on. CJCO is the next question.
Is
On
edging
investment
internal?
appraiser. Hello.
Is edging internal, like edging with the bank?
Hedging. What do you mean by hedging with the bank?
The exchange rate, edging the exchange rate, the payment or receipts.
So that is what method is that?
Money market edge, for example.
Okay. So that so in that case, you are arranging with a bank that,
yes,
okay, you are going to sell or you are going to buy in the future time and all of those things. So that may be seen as external.
Okay.
So that's more of external, just like for contract too. Okay. Hello. So CJCO is the next question on investment appraiser. What are we required to do? First is to calculate the net present value of project A and advise on its acceptability if the project were to be appraised using this method. 12 marks. B says critically discuss the director views on investment appraiser, and C says calculate the project specific cost of equity for project B and explain the stages of your calculation. So we'll be dealing with the first one here on this page, calculating the net present value of project A, and then we'll discuss or advise on the acceptability of that project. So let's look at what the scenario is all about. CJCO is a profitable company which is financed by equity with a market value of $180 million. So I want us to begin to note our relevant data. Value. This is market value. $180 million. So let's work in $1,000. And also financed by debt with a market value of 45 million. The company is considering two investment projects as follows. Project A, which is our focus here now. So this project is an expansion of existing business costing $3.5 million payable at the start of the project. So what does this represent? Hello, what does this represent?
At the end of the previous year.
So what does it represent?
Cash out.
Okay. 3500. which will increase annual sales by 750,000 units. So annual sales will increase by 750,000 units. Information on unit selling price and cost is as follows. So the expected increase in sales $750,000 units. So like I said, we're working in thousand. Selling price per unit, $2 in current price terms. Selling cost per unit, 4 cents. Variable cost per unit, 8 cents. All in current price terms. So what does that mean to you? Hello, what does that mean to you?
So it's either we inflate, so we have to inflate it.
It hasn't taken account
So
of
it is,
inflation.
there's no inflation in these prices, correct?
Yes, you need to
Okay,
inflate
so
them.
if we are now provided with information on inflation, we need to now inflate those prices. Okay. Remember in this question, the examiner didn't say work in nominal or work in real, isn't it? So, but he has provided you information on inflation, so expecting you to automatically work in nominal. So if you have the opportunity to read the question to the end, I'm sure we would have information as regards the discount rates given to us. So, but let's note the information given to us. Selling price inflation and selling cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. %. And also for selling cost, 5%. And for variable cost, inflation is 4% per year. Additional initial investment in working capital of $250,000 would also be needed, and this is expected to increase in line with general inflation. So here we have it. Incremental working capital. $450,000. So I'm noting it as this. We're working in thousand. Now we now have information about project B, but like I said, our focus here is on project A. So other information, CJCO has a nominal weighted average after tax cost of capital of 10%. Have you seen that? Nominal after tax work, 10%. Okay, that's also noted. And pays profit tax 1 year in arrears at an annual rate of 30%. Okay, so tax rate in arrears 30%. The company can claim capital allowances, which is also known as tax allowable depreciation, on a 25% reducing balance basis on the initial investment in both projects. Okay, so as it applies to project A, tax allowable depreciation rate is 25%. Risk-free rate of return is 4%, equity risk premium 6%, general rate of inflation 4.5%. So I think for the purpose of this project A, we need the general rate of inflation. Because we are told that working capital will increase in line with the general inflation. Please confirm you are following, please. Your class is silent.
Yes.
Okay, good. So we've noted this information. Now, one thing is that once you hear about capital allowances or tax allowable depreciation, quickly, that should be a strength of all students, okay? So quickly use that to hang your easy marks. So what do we do there? 25% reducing balance. So we set up a table, isn't it? Are we there?
Yes, sir.
So initial cost. What is the initial cost? 3.5, isn't it?
3.5.
Okay. And then CAD for first year.
25%.
25% of that figure comes in as inflow. He claims that. And then he pays CAD benefit of what percentage?
30%.
30% on that. Okay, 30% of 875 year. So what year will that happen?
Year 2.
Year 2, thank you. So what is the balancing allowance?
Add those two figures.
So the difference between these two, isn't it? Then what happened in year 2? %25 of this balancing allowance, isn't it?
Yes, sir.
Okay. And then it takes 30% of that as benefit, and that happens in year 3. So balancing allowance, the first one is balancing allowance at start of year 2. That's the first one here. So the next balancing allowance will be what?
Start of year 3.
Start of year 3. So what happened? Difference between these two.
Mm-hmm.
And then there'll be TAD year 3, which is 25% of this balancing allowance, but comes as inflow. So then takes what? 30% that. And that happens in year. Okay. Now balancing allowance at start of year 4. Difference between, or the net between this and this. Okay. So the project is ending in how many years?
In year 4.
Okay, so where did we get at? Let's confirm.
The last paragraph.
Director views on investment appraisal. The directors of CJCO requires that all investment projects should be evaluated using either payback period or return on capital employed. And that return on capital employed is also known as accounting rate of return. The target payback period of the company is 2 years, and the target return on capital employed is 20%, which is the current return on capital employed of CJCO. The project is accepted if it satisfies either of these investment criteria. The directors also require all investment projects to be evaluated over a 4-year planning period. So that's where the 4 years is mentioned. Ignoring any scrap value or working capital recovery. Okay, so please take note of this. So we are not even given scrap value anyway, so we should also ignore it. And we're also asked to ignore working capital recovery. So please take note of that. With a balancing allowance, if any, being claimed at the end of the 4th year of operation. So look at it. This is the balancing allowance at the start of year 4. So what do we do with that? It has to be claimed, isn't it? Everything has to be claimed at the end of the project life, which is year 4. So we are claiming this. So that will be equals to the positive of this, correct? And then we take 30% on that. And that will happen in year 5.
Year 5.
So with this, that's why I say this should be the strength of our students. With this can take up to 3, 4, 5 marks, depending on the marking scheme. Depending on the marking scheme and how magnanimous the examiner is for that diet. Okay, so I'm sure you won't want to lose such a mark. You know, minimum of 3, 4, 5. Imagine. So take note on how to calculate this and earn your easy mark. So we are done with TAD, which is going to flow into the appraisal template. So the next thing you'll be looking out for is how do you inflate all of these prices and also earn your easy marks from there. So can we do that?
Yes, sir.
Yes,
so
sir.
Here I'll just do this. I'll call this year. So I'll call this year 1, year 2, do my workings there for the examiner, and then inflate these prices. So in year 1, what happened? Equals to $2 to increase by what?
5%,
by 5%,
1.05 raised to power 1.
Bracket 1 plus 5%. Raised to power what?
1.
This one, isn't it?
Mm.
Okay, and then the next one will be what?
2 times 1.05 raised to power 2.
Okay. Third one, same thing, 2 times 1 plus 5% to the power of power 3. Fourth one, 2 times 1 plus 5% to the power of year 4. Another person would have said, okay, I haven't got this year 1 and it's the same rate and the same price as base. You can just continue to multiply this by 1 plus the rates. So you get the same thing, isn't it? Move on like that. So take this, the next one, year 2 figure, multiply by 1 plus 5%. Move on. Take the third one as I calculated, multiply by 1 plus 5%. So you all get the same thing, correct? So just to show you that. Moving on, let's do for selling cost. Equals to 4 cents times, we are told is the same 5% that applies to it, raised to power 1. Get 2, 4 cents times 1 plus 5% raised to power 2. Third one equals to 4 cents times 1 plus 5% raised to power 3. And the fourth one equals to 4 cents times 1 plus 5% raised to power 4. For variable cost, that is affected by 4% equals to first year 80 cents multiplied by 1 plus 4% raised to power 1. Year 2, 80 cents times 1 plus 4% raised to power 2. For year 3 equals to 80 cents times 1 plus 4% raised to power 3. And then for year 4 equals to 80 cents times 1 plus 4% raised to power 4. So go ahead your marks for all of these calculations straight. Without wasting time. So what else do you need to calculate? We are told working capital will increase in line with general inflation. Okay, so let's also do the computation for that quickly. So I have year here as well. Year 1, year 2, year 3, year 4. So what happens? This will be multiplied by 1 plus general rate of inflation, 4.5, okay? Raised to power 1. Are we following? Year 2 equals to 250 bracket 1 plus 4.5 raised to power 2. Year 3 equals to 250 times 1 plus 4.5 raised to power 3. So what happens in year 4? Remember, you are told that working capital recovery should not happen.
Yeah.
So what do you do?
We still continue.
So that means we should continue, isn't it? So there will be working capital in year 4. Okay.
Yes, sir.
So equals to what? 250 and 1 plus 4.5 raised to power 4. This is how the working capital would be. Now, the incremental part for the purpose of appraisal, we need to account for it. Okay. So I'm going to call these relevant incremental. Okay. So per year. So this is where we start from 250. Let's put it in negative. So what happens? So it increased to what? 261 by what? I see it, 11.25. Okay, it increased to 273. Let's even represent it from here as negative, so that so So this will be equal to this minus this. So the next one, continue like that. And this is how we have it. So we have 250 in year 0. You have this in year 1. You have this in year 2. So equals to this minus this. Okay. So you have this in year 2. You have this in year 3. And you have this in year 4. Okay. So this would be what we need in the investment appraiser. This is how the working capital has been changing. Is that change in working capital we need to account for in our investment appraiser as per time period. Okay. So we have our workings for working capital. So what other workings do we need to do? So those are the questions we ask ourselves. So we are told expected increase in sales will be 750,000 every year. So when we get to our investment appraiser, we can just do our calculation from there. So every year, 750,000 times the price involved. Okay. So let's go to investment appraiser proper. So where we say year, revenue, selling cost, isn't it? And then we have variable cost.
Variable cost.
And what else? Taxable profit, isn't it? Or cash flow. Okay, so then we'll charge taxes, and then we'll bring in tax benefits.
Tax benefits.
On TAD. And then there's no scrap, so we'll bring in working capital, isn't it?
Yes.
What else are we bringing? There's no
It should be relevant incremental.
Initial cost. Sorry?
It should be the relevant incremental.
Yes, relevant. That's what we are bringing. Exactly. Okay. So let's have it. This is year 0, year 1, year 2, year 3, year 4, year 5. Because of the TAT, year 5. So revenue in year 1 is equal to 0.1 we have here, multiplied by 750,000. Okay. In year 2 equals to 0.2 multiplied by 750,000. Year 3, 0.3 times 750,000. And then year 4, 0.4, 3 times 750,000. Selling costs. Let's put it in negative, equals to 0.042 times 750,000 here, year 1. Year 2, 0.044 times 750,000. Year 3, 0.046 times 750,000. And then year 4, 0.049 times 750,000. Variable cost as well. In year 1, 0.832 times 750,000. Year 2, 0.865 times 750,000. Year 3, 0.9 times 750,000. And a year 4, 0.936 times 750,000. We want to show them in detail. So you could also, another student could also do something here by just do the difference between the revenue and the cost and get a contribution, okay? So you can then use that contribution to multiply the units sold for each year like that. So you could do it that way too. So get used to what works best for you. So then we do the sum of all of this since we have put them in their appropriate signs. And we do everything up to year 4. So we have the taxable cash flow now. Then we can bring in taxes, but don't forget tax is paid 1 year in arrears. So which means tax on this 919.5 will be charged against year 2 cash flow. Hello, did you hear that? Someone should confirm.
Yes, sir. Yes,
Yes,
sir.
100.
Yeah.
Okay. And then
Yes.
we present our taxes in negative as well, please. So taxes at what? 30%.
30%.
30% of how much this year? 919.5. Year 2, we made this, so we just multiply that by 30%. Year 3, we made 1,027, multiply that by 30%. And then in year 4, the company made 1,085, multiply that by 30%. We bring in the tax benefit on TAD as they are going to be enjoyed. So the first one will be enjoyed in year 2. So we'll bring it in year 2 as an inflow. Cost to this. That of year 3, also bring it into the appraiser. That of year 4. And then finally that of year 5. So the next thing is to account for the relevant incremental working capital. In year 0, this 250,000, is it relevant or not relevant?
Which one is that, sir? What did you say?
It's relevant, sir.
250,000 working capital. Is it relevant in the appraiser template or not?
No,
It is relevant.
it's not relevant. It's the increase.
It's not.
Okay, so my question is deliberate. The last one we treated, what did we say? When we treated the question in I think the 4 or so.
Yeah,
It's
that
a
one
sunk
you said
cost.
We said what?
It's a sunk cost.
We said some costs, okay, $150,000 working capital, isn't it?
Yes.
Okay, what is the narrative behind that?
because that one, the project was already existing.
So that 150,000 was spent on the existing operation, isn't it?
Yes.
Okay, but what are they saying here? Additional
Initial investment
in working capital would also be needed. So this is a fresh requirement for this project. So this is relevant. Okay, you need to pay attention to the narrative, please. Okay, so we'll bring in this in year 0. And then we also bring in other ones as we have done their calculations. Initial cost of the project itself. Bring it in 3.5. So then we do our valuation, isn't it? So sum up all the cash flow and get net cash flows. We sum from where? The last summation was done at taxable, isn't it? So we sum from that end down to initial cost. And do for other years. Can we see it? And we apply our discount factor. At what rate are we doing that? Nominal WACC, after tax WACC. And that's what rate? 10%. Can you see it? 10%. Let's get the discount factor. Year one is 1. I mean, year 0 is 1. Year 1 is 0.909, isn't it?
Yes, sir.
0.826.
826.
751.
751. Yes, sir.
683.
683.
And 621, isn't it?
62. Yes, sir.
Good.
So like I've crammed this thing in your head.
I know 10% is a lot. I think it's up to 5 years. I know. I'm not sure I know the year 6. Okay, so moving on. So we now have present values. So this is going to be net cash flow multiplying discount factor for each year. And then we can sum all the present values to give us net present. Equals to the sum of all the present values. What do we have?
We have negative net present value.
Interesting. So when you see something like this, you feel uncomfortable, isn't it? So you just want to do a second check, isn't it? Just to be sure you capture everything. Because I'm sure everyone will be expecting positive MPV. Is that not so?
In a way, for this kind of like elaborate project, when they've given us a lot of details and...
Yeah, but you wouldn't know whether it's going to be negative.
Yeah.
So you'll be curious to say, oh, this negative, I hope I didn't catch, I didn't omit anything. Is that not so? So I'm just calling your attention to what is expected. Okay, so you just quickly check, just to be sure that you catch up, you've actually captured everything. So if you have captured everything,
18 minutes.
Well, it's part of what you need to do, you know. I don't know. You need to manage your time anyway. If you think, fine, you can, MPV, of course, is going to be like half mark or 1 mark, and you move on. It's not a problem. If you know you have wasted time on your calculations. But if you know you have been saving time, so you can just quickly do a check and then see that, okay, I've captured everything, and then you move on, isn't it? So I can see that we have captured everything. We have actually. So let's move on. So this is negative. So what is going to be our comment? Because we are also asked to advise on the acceptability. What's your comment?
Shouldn't be accepted because it's negative MPV will destroy the shareholder loss.
So we say project A's MPV is negative. So tell the examiner the implication of this before you now say it should not be accepted. Because the examiner can see that it's negative as you have calculated it, and you have earned mark for that. So if you are saying it's negative, you may not earn mark for just saying it's negative. So tell the examiner the implication. So project A's MPV is negative, okay? And if accepted, what happened?
To destroy the shareholders' wealth.
It will destroy the shareholders' wealth. Imagine all their wealth they built for so long. What are you saying? The project should not be undertaking. You can use your own language, it's not a problem. It's not compulsory you use undertaking, so it should be undertaking. So this is a good comment. So it should not be on that. So projects. Any question on this? Hello?
No question. No, I can only hope that this thing will be as straightforward as this and easy in the
Yes.
exam.
It is always as straightforward as this. The only thing that makes it look as if it's not as straightforward as this is the exam fever. So you need to manage that exam fever. Did you get that? So that's 12 marks for us. Let's move on.
Hello.
Sorry?
Please, can you quickly run through this tax available depreciation again?
Which one?
The TAD, the calculation of the TAD.
Oh, okay. So this is it. Initial cost at start of year 0. Sorry, start of year 1 I meant. Okay, which was the relevant figure at the end of year 0. So at start of year 1, this is the initial cost. Okay, so TAD for the whole year 1, we did it as 25% of this figure. We got 875. But you know, TAD is claimable, so it has to be represented as positive figure. So then on that TAD, the company will claim a tax benefit at the tax rate of 30%. So we apply that 30% to this, and we got to 62.5. And that benefit will be claimed in the same year tax will be paid. We are told that tax is paid in arrears. So for every inflow in year 1, the tax on it will be paid in year 2. So also tax benefits arising from this TAD should also be enjoyed in the same pattern. So which means the first one here will happen in year 2. Did you get that?
All right.
Okay. So we did a net of this position, which will be the carrying balance at the start of year 2. And then for the whole of year 2, there will be a TAD. So we apply 25% to that. And then we claim 30% of that TAD. And that also is claimable in year 3. So we did also the net of these balances, and we got an opening balance for year 3. So, and then TAD for year 3 is also applied at the rate of 25%. We got this, and then the company claims 30% on that, which also would happen in year 4 year. Then there's a balancing allowance, of course, which is the opening balance in year 4 of this value. But the project ends in 4 years. I mean, in 4 years time. So which means the balancing allowance in that year should totally be claimed. So which is this we're having here, 1476.6. Okay, approximately 1477 anyway. And then we applied 30% tax rate to that. Got 442, which is also going to be a benefit into the appraiser, and that happens in year 5. That's how we calculated the TADs and the tax benefits.
Okay. So this last one, we calculate the 25% on it.
So the last one, we did not apply 25% because everything is going to be claimed.
Okay.
Can you see it?
Thank you.
You are welcome. So that's the end of A part. So let's look at the B part. So now,
sorry,
after I've
sorry
said,
to drag,
sorry, say that.
sorry to drag the class back. Sorry to drag the class back. The TAD calculation, the last part of it.
This one,
I don't know. Yes, the last part.
the TAD. This
Yes,
one.
I don't. Yes.
Okay, so this is the balance at the beginning of year 4. The project ends in 4 years' time. So which means everything remaining in year 4 should be claimed by the company as TAD. So they claim the entire 1477 in year 4. On that, there's tax benefit of 30%. So we apply 30% to this figure, which gives us 442.96. Blah, blah, blah. And then that will be claimed as benefits in year 5.
How did you get the 1476?
The what?
How did you get the 1476?
So it's just going to be the same value here. We just put it as positive. That's all.
Because
Can you see
you
it?
said 492.1 minus 147.6.
No. This one, okay. How we got it initially? Yes, is the net of these two. That's all I said. Net of the two. So this is a total of 1969 as a cost. Then there will be a TAD to be claimed out of it of 492.19. So it gives a balance of 1477. That way I said. Okay.
I've got it.
Any other question? Okay, so there's no question. Let's move to the B part. So after I've sent this also to you, so it says critically discuss the director's views on the investment appraiser. You remember what their views are, okay? So let's go back to what their views are. So I can bring that in. Look at their views. Okay. Look at their views. Directors of CJCO require that all investment projects should be evaluated using either payback period or return on capital employed. Target payback period of the company is 2 years and target return on capital employed is 20%. And that is the current return on capital employed of the company. A project is accepted if it satisfies either of these investment appraisal. So critically discuss that view. That's the first view. What can you say about it? When you see the word critically, so critique it. Say something good or bad about that view. So if you're evaluating investment projects using these payback or return on capital employed, what can you say about it? So I think I've sent these to you. We are saying the two methods do not consider time value of money and they do not also consider risk. So that is a drawback. The directors did not consider that. So because if they have considered that, they wouldn't be saying all investment projects should be evaluated using those methods. So you draw the attention of the directors to this. Also, you are saying that their result may be putting investors at disadvantage of making suboptimal investment decisions if they are using any of these methods. Because the reason is that since these are not considering time value of money and also not considering risk. So in the event of risk, what happens? Because there will always be risk associated with a project. And if those risks are not considered, then what happens? Investors will be misled by you saying that that project should be accepted. Whereas if risk is considered, it is likely that that project should not be undertaken at all. So it could be misleading in that way. So it may be important to adopt a more reliable method that considers risk and time value of money, like project-specific cost of capital, like discounted payback, and so on. So you're advising to say their views, is a bit not a good one for the company, because investors are likely to be misled going by these methods. The second point is that they also said something. Let's look at it. Director also require all investment projects to be evaluated over a 4-year planning period. They also mentioned that. So what's your view about that? Do you think that's a good one? Yes, if you say we should use 4-year project life, it may be a good one. So because if the project life is elongated, uncertainty tend to increase, because the cash flow you are going to project into the elongated period may not be realistic, may not be certain. You may not be sure of, those cash flows. So uncertainty tends to increase as the project life increases. So it will be better to shorten the project life. You are saying that. That's fine, no problem. However, it is equally important that the director consider the whole life of the project to help make an optimal decision and increase the possibility of achieving a positive NPV. Why are you saying this? Because our solution shows that we have a negative NPV. So which means that it may be important to look at what the period beyond year 4, what are the cash flow that are associated with this project, going by those periods. Maybe the project may have something more significant as cash flow in periods after year 4, and that can turn the project's NPV to positive. So that's what we are trying to say here, that maybe 4 years is not a good one eventually, because the NPV, as calculated, is negative. So we may need to extend the project life a little bit so that, the cash flows into the future can also, affect the value of the project. Most likely, or more likely, will turn to positive. The next point here. Director say ignore any scrap value. Now, what's the implication of that? So we say scrap value is a relevant cash flow to an investment project. And the essence of realizing scrap value is to improve the value or the worth of the investment eventually. You can't say a project is undertaking that worth 3.5 million initial cost and nothing is being realized at the end of the project. It's very unlikely, okay? So, which means if you ignore scrap value, you are probably undervaluing the project. So ignoring this may be a cause of the negative NPV obtained from the appraiser. So at it being we have a value realizable from this project, it may turn out to be positive NPV. That's the importance of the scrap value. The next thing the directors have said is that we should also ignore working capital recovery. Now, remember that the usual assumption about working capital is that at the end of the project life, all the total spent on working capital should be released back into the project as what? As a cash inflow to improve the value of the project, because it's an investment. Okay, so you use it to improve the value of the investment. But in this case, the directors are saying the working capital recovery should be ignored. And the implication is that this will then undervalue the project, which may also be the reason why we have recorded a negative NPV on this project. Are we following? The last view is saying, balancing allowance, if any, should be claimed at the end of the 4th year of the operation. So look at it. What's their view? So let's critique that view. So balancing allowance at the final year. Remember, we realized about $422,000 in year 4 as tax benefit, which was, enjoyed in year 5. So that's a huge value, which has also affected the value of the project. But guess what? If the project life is extended beyond 4 years, we won't be able to claim that balancing allowance. Okay, and what will that mean? Okay, that means that may overstate the value of the investment. Claiming it in year 4 may mean that we are overstating the value of the investment. But if we have extended it beyond 4 years, so that means we'll get, some kind of reasonable values that, placed into the future. And then the true value of that investment will be obtained. This means that the $756,000 negative NPV we have gotten may also be that it could have been worse than that value if we have extended beyond year 4. Because the longer the period, the discounting factor implication is that the value realizable will be coming lower the longer the period. Okay, because that discount factor will be diminishing into the future, and it brings down the value of the project. So what this is telling us that it is possible that this $756,000 is overstated. Okay. Any question on this part? Any clarification required?
Please, sir, can you just clarify on this last point? The 700 that you said is overstated.
Yes.
I'm really not getting the...
So what I'm saying is that the directors, they are saying that the balancing allowance should be claimed at the end of the project life, which is year 4. Okay. Now, let me take you back to when you see figure, you understand what I've just said. So let me take you back to our calculation. Look at tax benefit on TAD. In year 4, look at what we have realized. So it was 262 year 2, 196, 147 is getting lower. But look at year 5. We realized 443. And why did we realize this? Because the the balancing allowance was claimed at the end of the project life. And how much was claimed? Look at it. Huge amount. 1.476 was claimed. But look at what has been claimed in the previous years. 825 year, 656 year, 492 year, but 1.476 or 477 was claimed in the final year. And that's what took this to a high level of $443,000 TAD benefit. So this is a whole lot of value, increasing the value of the project, which means that if, for instance, let me just adjust this for you. If, for instance, instead of having 443 here, we have something lower. Let's say we have something like 300. Check what would have happened to the value of the project. Currently it's 756, isn't it? Negative. Look at what will happen. Can you see the implication? What can you see there? 844.
Yes.
Is that not so? Which means that
Yes.
$756,000 that we saw there is an overstatement. And if this is a lower value, and then the period is also extended to year 6, year 7, something like that. You know, let's say year 6, year 7, which means that what we will be claiming in year 7, for instance, will be something lower. And by the time you discount those values, by the time you discount them, they will come lower. Are you with me now? And then it will turn out to be that the negative NPV keeps increasing. It will keep increasing because the value is reducing. The value of the project is reducing. Are you with me now?
Yes, sir.
Okay, so that's what I was trying to explain.
Okay, noted. Clear.
All right. So is there any other clarification from anyone? So if there's none, let's quickly go on break for 15 minutes. This is 4:05. Let's go on break for 15 minutes.